Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. In this video, we're going to talk about something that I truly believe a lot of people are still not informed on, and that's going to be your Vantage score, specifically your VantageScore 4.0, and why it's going to matter in a much bigger way in 2026. Now, for years, whenever people talked about credit, including myself, the conversation usually started and would end with your Fico score. If somebody asked what your score was, they usually meant your Fico score. And if somebody wanted to know whether you can qualify for a car, a house, or a credit card, they were usually thinking about Fico. And to be clear, Fico is still very important. As of early 2026, 90% of top US lenders still use Fico scores today to assess credit risk. So Fico does remain the industry standard, even as newer models like Fico Score 10T and those incorporating alternative data like rent and utilities gain traction to improve financial inclusion. But there's another scoring model that has been gaining more ground behind the scenes, and the people who understand it early are going to have serious advantages. That scoring model is VantageScore. More specifically, your VantageScore 4.0. It is becoming a bigger deal, especially as the lending world continues to evolve. So if you're a business owner, an entrepreneur, an investor, or someone who's serious about leveling up financially, this is one of those topics you don't want to ignore. By the end of this video, you're going to understand what the Vantage score is, why it's been gaining traction, how it compares to your Fico score, and why it could impact mortgages and business funding in 2026, and what you should be doing right now so you're not caught off guard later. So without further ado, let's get right into the video. Now let's talk about why this conversation is becoming even more important in 2026. Across the US, lenders are increasingly using VantageScore 4.0, although adoption still varies depending on the type of lending. While Fico continues to dominate in overall scoring volume, VantageScore 4.0 has firmly established itself as the leading alternative and in some areas the emerging standard. One of the biggest reasons for that shift is what is happening in the mortgage space. Now, we talked about this before in a previous video, but changes were approved by the Federal Housing Finance Agency. Mortgage lenders that sell loans to Fannie Mae and Freddie Mac are moving toward integrating VantageScore 4.0 into their systems. After a multi-year transition, the mortgage industry is expected to reach full operational integration sometime this year, with lenders now able to deliver loans using either classic Fico or VantageScore 4.0. And that's why this matters so much. Vantage 4.0 is a much more advanced model. It's built to analyze credit data in a broader and more modern way. Think about it like this. The way that people use credit today is different from the way that people used credit 20 years ago. We have digital banking, we have instant payments, we have online lending platforms, we also have buy now, pay later systems, and faster reporting cycles. The models used to evaluate credit have evolved along with all of that. VantageScore 4.0 was designed to do a better job of analyzing how people actually manage credit over time. It looks beyond a single snapshot and pays more attention to behavior patterns. That's a major shift because now your financial habits tell a bigger story than just 1 month's balance or one isolated event. This also matters even more because the mortgage industry has started opening the doors to a newer scoring model. For a long time, mortgage lending was heavily tied to the older Fico models. We're talking about scoring systems that were built for a very different era. Those older models were still being used even though the financial habits of consumers had changed drastically. As the industry starts allowing newer models like VantageScore 4.0 into the conversation, that sends a message. It tells you that lenders are becoming more willing to rely on updated scoring technology. And when mortgage lending shifts, other parts of lending usually do not stay far behind. Personal loans, auto loans, credit cards, even some business lending decisions can start following similar trends. That's why understanding VantageScore 4.0 right now is not just interesting, it's strategic. Now, I haven't seen a fully condensed list of lenders that pull your Vantage score, so I tried to put a short one together. As of 2026, the following banks and credit unions may either pull your VantageScore 3.0 or your VantageScore 4.0 when reviewing you for certain products. Georgia's own credit union, Broadview Federal Credit Union, Randolph Brooks Federal Credit Union, Petal, Wings Credit Union, Fifth Third Bank, BMO Harris, Baxter Credit Union, Security Service Federal Credit Union, Alliant Credit Union, Jovia Financial Credit Union, Regions Bank, and Synchrony Bank. To clarify, some of these are based on pools that I've personally seen, while others come from lender disclosures or reported data points. For example, a few institutions like Synchrony Bank or Georgia's own credit union and Regions Bank, they have publicly indicated that they use VantageScore 4.0 in certain situations. That said, I also came across some conflicting information on a few of these lenders, so take parts of this list with a grain of salt. Still, it does show that the shift towards VantageScore is starting to happen. If anyone else has confirmed banks or credit unions that pull your VantageScore, then please drop them in the comments below. I would love to make a full guide from that information. The point is, different lenders use different models. Some may rely on your FICO score, others may use your Vantage score, some may even look at multiple versions depending on the product. So if you only know one score, you may not actually know how you look to the next lender that pulls your credit. That can create some real problems. You might think you're in great shape because one score looks solid, then turn around and get hit with a surprise denial or a less favorable offer because that lender used a different scoring model. This has even happened to me recently. On the other hand, you might underestimate your profile because your FICO is lower while your Vantage score is actually stronger. That's why now I tell people all the time that credit is not just about having a score. It's about understanding the system behind the score. Imagine your FICO score is a 710, which most people would probably feel really good about, but your Vantage score is sitting at a 665 because of a recent utilization spike or a short-term balance increase. Vantage 4.0 uses trending data, so instead of just looking at your balance today, it'll analyze whether your balances have been increasing or decreasing over the past few years. So if you had high balances the last few months, you may not be able to use that pay my utilization down to 10% trick to boost your score instantly. Your Vantage score takes into account years of history. Also, payment history is extremely influential. Roughly 41% of your score is based on-time payments, which is the most critical factor for VantageScore 4.0. Credit utilization, or the age or type of credit, will account for 40% or 20% each respectively, while the remaining percentages focus on overall debt levels and recent credit inquiries, and a small percentage goes to available credit. If a lender leans more on your Vantage score, that lower number could change your entire outcome. It could affect your rate, your limit, or whether or not you get approved at all. The bottom line is simple. In 2026, knowing only your FICO score may not be enough. You want to know both, and you want to understand where they differ. So next, let's put them side by side. At the highest level, both scoring models are trying to do the exact same thing. Both want to find ways to predict the likelihood that you will repay debt responsibly. But they don't weigh everything the exact same way, and they don't always react to new information at the same speed. One major area is payment history. Both models agree that paying on time is critical. That is still the most important factor in the credit world. 35% for FICO and 41% for your Vantage 4.0 score. But VantageScore 4.0 tends to be a little more responsive to recent behavior. Another key area is utilization, which is how much of your available revolving credit you're currently using. Both models once again care about this a lot. 30% for your FICO score and 20% for your Vantage score. But Vantage scores can react faster when balances change and creditors report the update. So if you aggressively pay down a card, your Vantage score may reflect that improvement sooner. Of course, the reverse is also true. If you suddenly run balances up, it may punish you faster too. Not to mention that data is trending, so it still takes into account your past behavior. Then you have account age and credit mix. Now, FICO historically leaned a bit more on the length of your credit history and the mix of revolving and installment accounts, with 15% in length of credit and 10% in credit mix. VantageScore still considers these things, but it also pays close attention to patterns over time, with depth of credit at 20% and recent credit at 11%. That means if you recently opened new credit but are managing it responsibly, VantageScore may not be as harsh in certain situations. The best way to think about it is like this. FICO often feels more like a long-term report card, while the Vantage score feels more like a live progress report. One tends to reflect the broader history with a bit more weight, while the other can be more sensitive to what is happening right now. That's why both matter. One shows stability, the other shows momentum. However, the reason VantageScore 4.0 is considered more modern than earlier scoring models is trended data. Instead of only focusing on where your balances are at this exact moment, VantageScore 4.0 can evaluate how your balances and payment behavior have changed over time. That means it's not just asking what do things look like today, it's also asking what direction is that person moving in. This is powerful because two people can have similar balances right now, but very different habits. One person may be steadily paying down debt and another may be slowly increasing debt every single month. So for example, let's say two people have a credit card that has a $2,000 credit limit. If one person is using $1,000 and the other person has $1,000, their utilization is 50%. It's the exact same. However, under Vantage 4.0, if one person was at 70% and worked their way down to 50, they may have a higher score than someone who had a 30% balance and moved up to 50 because the information is trending data. It's showing one person's actually using more, which can look risky, while one person is paying it down, which can look good. The point is that trended data helps the model see the difference. Another important feature is that the model will use more advanced analytics to assess risk, especially for people with thin credit profiles. This matters a lot because people who were historically hard to score under older systems can now be evaluated more effectively. This could be huge for younger consumers, people who are rebuilding, or even certain entrepreneurs who may not have a deep traditional credit file, but are still handling obligations responsibly. The system is trying to become more inclusive without completely lowering the standards. Now, if you're a business owner, you really want to lock in on this part. A lot of entrepreneurs think that business funding is completely separate from personal credit. Eventually, if you build a strong business profile, it can be more separated, but in the early and middle stages, your personal credit still matters a lot. It can impact your approvals for business credit cards, lines of credit, equipment financing, vendor accounts, and even certain loan products. Lenders want to know who they're dealing with. They want to see how you manage obligations personally before they extend risk to your business. This is just the reality. So if more lenders begin incorporating VantageScore data into their underwriting, this means that you cannot afford to ignore it. You don't want to be one of those people who say my FICO score looked good, so I thought I was fine, while a lender is evaluating you through a completely different lens. So if you want to position yourself for business funding in 2026, then your first job is to make sure your overall credit behavior is strong across the board. That means keeping utilization low, paying everything on time, protecting older accounts, which is now becoming far more important, limiting unnecessary hard inquiries, and monitoring your report consistently. Business funding follows discipline, it also follows responsibility, and it follows patterns. If your credit profile shows lenders that you can manage risk well, opportunities do become easier for you to access. This is why monitoring matters so much. But at the same time, don't become obsessed with the number itself. Yes, the score does matter. Of course it does. But too many people stare at every tiny fluctuation and they let that throw off their entire mindset. The score is a reflection. It's not your identity. It's not your worth. It's a measurement of patterns. If your habits are strong, the score will eventually catch up. If your habits are sloppy, the score will eventually expose that too. So instead of chasing points, focus on becoming the kind of person whose habits naturally produce strong credit. That's why I always talk about belief, mindset, and also action. You have to believe you can learn this system. You have to believe you can improve, even if credit has been confusing or frustrating in the past. That makes it more important for you to move with consistency. Not emotion, not panic, not random decisions, consistency. Pay on time, keep balances low, monitor your reports, and stay educated. You want to be proactive. When you do that, credit stops feeling like a mystery system that's happening to you, and it starts to become a tool that you're learning to control. Now let's go over what you should do right now. The first thing is simple. You want to check your Vantage score and you want to compare it to your FICO score. I'll put a link in the description for a site where you can access all three scores. Now, don't assume that they're saying the same thing about your profile. You want to look at both and understand where the differences are coming from. The second thing I would tighten up is utilization. Now, this is one of the fastest ways to influence both scoring models, especially if your balances have been creeping up. The lower your revolving utilization, the better your profile tends to look. The third thing is to protect your payment history at all costs. One late payment can do real damage, and even though the Vantage score may respond faster to improvements, you still don't want to create any unnecessary setbacks. And late payments is one thing that will absolutely kill both of these scores. The fourth thing is to monitor your reports consistently. Not once every 6 months, not only when you're about to apply for something. You want to consistently monitor all the changes on your credit report. That way you can catch any issues early and stay in position. And finally, keep learning, because the people who understand where lending is going are always going to be in a better position than people who are reacting late. I want to thank you guys so much for watching this video. At the end of the day, the Vantage score is not something you should brush off as just another number. It is becoming a more meaningful part of the credit conversation, and as we move deeper into 2026, the people who understand how this works are going to have an edge. This doesn't mean Fico no longer matters. It absolutely does, but this does mean that the credit world is expanding, and if you want to stay competitive, you need to understand more than just one system. VantageScore 4.0 represents a more modern approach to evaluating credit behavior. It looks at trends, it reacts faster in many cases, and it's becoming more relevant in major lending decisions. That is why now is the time to pay attention. Do not wait until lenders make a decision using a score that you never bothered to understand. Don't wait until you're applying for a mortgage or a business line of credit or major funding opportunities just to realize the system has shifted. You want to learn it now. Track it and strengthen it right now, because the people who win financially are not the ones who know everything. They're the people who stay aware, stay prepared, and move forward before the crowd catches on. This will be how you build better credit. This is how you become more fundable. And this is how you put yourself in a position for bigger opportunities. Once again, thank you guys so much for watching this video, and you have a wonderful day.